Hello, everyone. Welcome to Now Next Later for Monday, August 25th. We are very excited to talk. We is me, because if you watch this show every week, you know Sasha is the co-host and co-founder of Now Next Later, and Sasha is off today. So it's TJ and Jeremy one-on-one, which I'm really excited about. And if you've watched anything, if you're in this industry, you read Chrisman, you've been around, then you probably already know TJ. TJ's from Stewart Lender Services, and we're going to talk all things strategy, product innovation, and the future today. Before we do that, just want a quick note. We are sponsored by Cloudvirga. Yeah, we got our little background here. We're in great shape. And Cloudvirga is the architect of Tropos. That's a next generation loan portal, and that's redefining how lenders engage with borrowers. So last week, we talked a lot about consumer expectations, market research on digital. What do people expect? What should we be delivering? And in this conversation, we're going to build that out. So as you think about your lending channels and how you make it easy to apply, to digitally verify, to underwrite, to close, the full thing, that's what Cloudvirga is doing. That's what Tropos is doing. And so what we thought we would do today is keep the momentum rolling on this theme. We have a lot of people doing year-end strategic planning or budgets, whether your budget starts October 1 or January 1. This is starting to get into strategic planning and budget season. And so, TJ, welcome to Now Next Later.
Thank you.
We kind of frame the half an hour that way, now, next, later. And when we say next and later, we know there's a lot of people out there speculating, and it's really hard to know what 5 years from now is going to look like. So what we try to do is we try to talk about what should you be looking out for as you make these important investments and these plans. What are those key indicators? What are those flags that you need to have kind of special sensitivity to know, oh, there's one. TJ said if that happens, we should be aware that things could be going this way or things could be going this way. So, we don't really have an episode that isn't about change management or AI in some way. Those things come up all the time. So I know they'll come up here. Also, you and I have been working a lot in that home equity, shared equity space. And so I really want to pick your brain on shared equity and home equity as well, where you see that. And then we'll try to close out with, like I said, some of that look ahead. What's your sense where things are going from a regulatory perspective, rates? What do you think people should be kind of keying in on over the next 6 months, that if it happens, it probably means this or this? So that's with that set up. Thank you for being here, man. It's so good to see you.
Good to see you too, and thanks for having me.
Yeah, right on. Well, that's where we'll start. I'll start with that kind of home equity. What's going on right now in the industry? That's been the product that's strong. So you tell us, what are you seeing?
I love the HEI product set, but I will tell you that in the cycle, we're very much in the same place we were when reverse mortgages came out. It's an innovative product set. The market has moved faster than regulatory agencies have kind of figured it out. The idea of an option equity play, really, the structure of it falls outside of most traditional mortgage lending regulations. And regulators are waking up to the fact that there's this product that is growing in market share that they don't necessarily have a handle on. And so what we've seen are actions by different regulators in different states, most notably, most recently, Washington State with Unison. There was a Court of Appeals case that came out. Unison had won at the trial court level, declaring that the product was not a mortgage product. They lost that fight at the appellate level, and it was declared that they are, in fact, in a legal reverse mortgage because they have not complied with the state laws. They're, I believe, appealing that decision. I think that we're going to be seeing more actions around that, and the smart, good actors have gotten ahead of that. They've been talking with the state regulators. They've been saying, "Hey, what can we do to carve a path that meets your expectations while we wait for more formal guidance or legislative action?" I have regular conversations with a couple of different market leaders, and they are really doing some things like, hey, let's get some counseling in place. Let's get, like they do for reverse mortgages, HUD counseling, something similar. Let's get some uniform disclosures in place so that it looks the same, kind of like TILA, so that consumers can shop between different providers with visibility. And so what we're seeing is the market is evolving to where they are essentially self-regulating themselves into what will eventually be the regulatory regime. And once that gets secure and there's a better understanding, that's when we get those we're already seeing some securitizations, which is fantastic, injecting liquidity back in the market. We're going to be seeing some rated securities coming up. Hopefully we'll get to that point. And that opens a whole new class of investors. It opens up insurance companies. It opens up pension funds. The idea of a rated security,
Yeah.
it really opens up the floodgates from a market perspective. And the timing is so unique in the market where there's so much equity, but at the same time, consumers are under record debt load. And so the ability to take on a traditional HELOC or closed-end second from ability to pay perspective is strained. And so consumers are able to downsize their payment structure, be able to pay off some of that high interest debt into an equity share in exchange for the future appreciation of their home, and really solves a right now problem and puts the consumers in a much better place, assuming that they are able to change the lifestyle, change this pace at which they were incurring debt, and really put a period behind it. So I'm really bullish on the product set, and I'm glad to see that we're seeing this evolution, voluntary at this point, in partnership with the regulators, to be able to come up with a product set that will be beneficial for consumers and is transparent and shoppable and all the good things we like to see.
Yeah, right on. I mean, I feel similarly, and one of the things you mentioned is that milestone. When we get when we get a rated security, that is a huge milestone
Huge.
for
Yep.
any product to say, all right, now we know we've got even more standardization, and we unlock, like you said, that whole capital market, secondary market that we need. One of the things I wanted to dig into that you said from your background with your legal experience, it was always fascinating to me, and it took me a minute to appreciate it because for me, the logic was around what you said. When I saw this product at Rocket, when I was at Rocket, we had already been planning a closed second lien product and
Yep.
probably eventually a HELOC product at that time. And
Yep.
they've already securitized their own closed-end seconds.
Yep.
But what I could never understand is, and I want to get your experience with it, which is if you have a debt product that adds to a monthly payment and sits out there with virtually no competition, what's the consumer risk of adding an asset, an equity product next to the debt product, comparing the two of them, shopping the two against each other, and just saying, here's the terms of one, here's the terms of the other, here's what the outlook is. That's what loan originators do
Yep.
all day, every day, is they
All
show
day. Yep.
numbers, they do the comparison, and yet regulators took a much darker view and
They did.
didn't really trust originators. I mean, I'm putting words in their mouth a little bit, but it felt to me like they didn't trust originators to just explain the math, which is what originators are here to do. So why the dark view, and like
Yeah,
where
it's a couple different things, and I've had some conversations with regulators, and again with some of the leading companies. To your point, I think there's a really good use case for this product, and I kind of went through something similar not that long ago when I was with Finance of America. Finance of America Reverse came out with a proprietary product, which basically was the standard FHA reverse mortgage with some of the lending limits removed from a dollars and cents perspective. And
Yep.
we had kind of a similar uphill battle, but we had some existing kind of guardrails and railway laid out by the traditional reverse mortgage product. The challenge is this, Jeremy, from a lending perspective. Number one, a lot of the originators of these HEI products very specifically said to regulators, we are not regulated by you. We're not a mortgage product. And so there
Mhm.
are no guardrails from a SAFE Act perspective. There is no licensing. And so the image was, like you said, if it's a traditional MLO that you know their good behavior, you know the guardrails around it, maybe you feel comfortable. But because they said specifically we're not bound by the regulatory authority in mortgage, we're not bound by SAFE Act, and as an initial reaction, I think we've moved away from that. But initially that was the stance, we're not a mortgage product. Regulators had a very strong allergic reaction to that. We also see that if you do out the math on the upside exit of the option contracts, they greatly exceeded state level usury laws. And so you're seeing, 30-40% effective interest, depending
Mhm.
on the how that option retirement is priced. And so
Mhm.
you see regulators having just an absolute allergic reaction to that and saying, hey, you're saying that you're not licensed. We have no control. If there's a complaint, we don't know where to go to. We don't think you're properly disclosing it. We can't trust that traditional MLOs that we know and believe are on there doing this work, even though they might be. And
Mhm.
three, you're outside of what we think are the lending guidelines and caps, and we also don't trust consumers to make their own choices And a lot of these consumers are down credit. It's not really a credit product, it's an asset product. And so you
Right.
have some consumers that are in the 500s from a credit score perspective. Not a whole lot. Most of them are in the mid sixes to 700s. It's people who are smart with their equity and found themselves in a asset rich, cash poor, cash strapped, debt laden place. Uh, but there's this regulatory view that it's there's a market segment of not financially savvy individuals with no regulatory guardrails around it, and so it is concerning to them. And I will give the industry a lot of credit. The good actors have said, "Yeah, we hear you. Let us move to a place that like makes a little bit more sense. The returns are great. Let's find a place where we're all happy, where investors feel comfortable investing, where we're not knocking heads off from essentially an effective APR perspective, and we're moving towards that. I think that it's still probably an ROI that's higher than a HELOC or closed-end second with good reason. There's a high long-term risk given the position. You're not de-risking on a monthly basis the way you are with a mortgage payment with amortization. And there's
Mhm.
still some uncertainty around the enforcement mechanisms on a state-by-state basis. And so there is a premium that a investor will demand for that risk, but it's now in the reasonable realm.
Yeah. Yeah. One of the things I got to do, this is going back at least a year, it actually might be 2 years now, was I got to do some research with my friend Marvin Chang
Yeah.
about, yeah, I know you know Marvin, about
Or-
what type of homeowner is kind of stuck. And we hear a ton about people with a low rate first mortgage that is not allowing them to move up or downsize. We hear all the kinds of things about that borrower in particular. What we don't hear as much about is the borrower who got their mortgage, so they were credit qualified at that time, and something happened. They have fallen out
Right.
of credit qualifying for a HELOC, and also in doing so aren't really that keen to add a monthly payment on top of their first mortgage anyway, because the thing that dropped them out of credit quality also is affecting their cash flow.
That's right. Yep.
And they're sitting on record equity that they're not allowed to touch. Marvin likes to describe it as the safe in the basement that you don't have the code to.
You have the code
Like,
too. Yeah.
how do,
Yep.
how do I deal with this? And so one of the things that I have been hoping does form when as we standardize these products is just a solution for people who go, look, I'm allowed to hedge or diversify almost every other financial product in the world except my mortgage, except my
Yep.
house. And this ability to sell part of it to an investor for cash without a monthly payment might free me up. And to your point, depending on the term, right? The devil's in the details, obviously, but it can be some relief for these 9 million people that Marvin identified in his research that could be in that position. So, anyway, that's just kind of why you and I are talking about it, why it's such an interesting product. I think more IMBs are going to want to do it once they realize that they can sell multiple things, right? If you can sell ABC and let the person pick, let your loan officer walk them through their options, I think it gets to be stronger.
I agree. And I actually partner with a couple of other companies that are looking at fractionalizing the equity in the home via blockchain, which
Mhm.
maybe is a next item.
Yep.
But we
Yeah.
can,
Yeah.
I think that's a really another interesting way. What we see in the market now is folks, Wall Street money, who have traditionally been build or buy to rent on the market, saying, there's still some downside headline risk to that model. Can we diversify in a way that changes our exposure but preserves essentially our internal rate of return on an investment? And so there's some platforms that are in development now that would be deployed on blockchain, fractionalize the back end, and essentially use a tenancy in common agreement. And
Mhm.
essentially
Mhm.
it would be a refinance of the first mortgage and a tenancy agreement and an occupancy agreement. And the net payment is actually very competitive even with the low rates. And so there's still that opportunity to do that without ultimately affecting your monthly cash flow from a perspective. And again, that's a savvy consumer making that choice, but that product's in development now.
Yeah, I think that makes me think of a couple things. But the primary one is in order to do more of these types of products more quickly, in order to have them have more component, either investors, owners, or shared partners. You mentioned it a second ago, and I want to make sure we don't gloss over it. We
Yeah.
need the valuation. We need the valuation on the house to be stronger than ever. as
Yeah.
well, because the stronger the valuation is, the more comfortable we feel de-risking these products because we know here's where we're at and here's how that value is changing one way or the other. What are you seeing in that space, and
Yeah, so it's
what
funny
can
you say that. See, so there's two components there. One is really, we taking some of the tool sets we've used for appraisal modernization for the GSEs, for the remote inspection, being able to have apps and on-demand and homes inspections for veracity. Uh, that's number one, to get kind of that on-demand. I said, obviously you can pull an AVM in the comps and have a very high confidence score yet, but ultimately that asset is as important, and the ability to do on-demand or close to on-demand validation of the asset. And the other is what we've been calling title as a service,
Hmm.
which is this idea of being able to use validated data products and to fractionalize the process so that you're doing essentially a riff on portfolio monitoring, but an on-demand item to make sure there's no involuntary liens or other things going on. So as you're fractionalizing or tokenizing or transacting on the back end these assets, you have the ability to pull calls at a very, very cheap price point, validate what has happened to the status of title and to the valuation and condition of the property, and be able to in real time basically do those updates, change any policy structures, change any fractional ownerships and any recorded security instruments, and have some thresholds for that. That's really the mechanism that we've seen, and it's basically what's old is new again. It's like the idea behind MERS, right, where you're doing all these
Yeah.
transactions and then you update the public record. We're kind of looking at the same thing where we have a system of record outside the public record. We're gathering all these data points, and when they hit a threshold, we hit the update button, and then the public's aware now. ABC hedge fund owns 89.5% of the property. The homeowner owns the remaining 11.5% or 10.5%. My math, I'm a lawyer, not a mathematician.
Yeah.
But the idea of being able to drive that as a service by using data sources, and that's one place where we see some action happening. Obviously, the development of blockchain, which is another maybe uh, next moment, but there is a
Yeah.
working group to put mortgage and real estate transactions on blockchain using the Hedera protocols. That's a working group that just got spun up. It's very exciting. I'm part of it, and I'm happy to talk more about that too.
Yeah, let's step into the next because obviously, we're halfway through our time together. And so, like, in that next category, one of the things that you and I talked about very early on when it was blockchain that was the
Yeah,
shiny new
yeah,
object instead of AI being the shiny new object, one of the things that we talked about at that time was it works really well in the conversation about infrastructure,
yeah.
market infrastructure, and it fails a lot when you're trying to sell it as the product itself, right? And so we stopped, I think a lot of technologists, a lot of people on the business side talking to technologists, stopped selling blockchain as the product itself and started to just talk about it as infrastructure. It's market infrastructure. That's all it is. And so
That's
and so
that's
to
it.
your point, does that mean in your view that now because that shift has happened, a lot of money and investment has flown to other places like AI, that it's actually given some freedom, maybe some breathing room for blockchain to kind of build out more of the infrastructure, the rails, so to speak, needed for title valuation and some of these other products?
Yeah, so I think you nailed it. I think it's two things. One, we were having these conversations as much as 5 years ago. I mean, it feels like we've had the same beating our heads on the wall. Blockchain is a product, and it was because we struggle with the monetization of building the rails. That's number
Mhm.
one. And then building the on-ramp and getting people on it, and how do you get critical mass, and all of those things proved to be incredibly frustrating. What we've seen now, as you said, with the investment moving to AI, and I joked that you couldn't see us off camera, but if I hear agentic AI one more time, I'm going to lose my mind. Uh, but I think part of it's the regulatory clarity. I think at one point we saw blockchain and crypto get conflated by the regulators, and I think that I don't want to put my tinfoil hat on, but there's some pretty big financial institutions that are building essentially their own Fed coin or whatever you want to deem it. But the
Mhm.
idea that all of that got put on hold through some muddying of the waters, those waters have been cleared. We have the Genius Act. We have other things that are pushing kind of more blockchain or crypto driven currency uh, drives right now, but it's given a pause back. The swirl is gone, and now we're
Mhm.
left with the real use case of blockchain, which is as you said, as infrastructure, as fancy Excel spreadsheets, as filing cabinets, as rails, the ability to drive transactions efficiently without feeling the need to productize it. And the idea of having people who are market participants build it together as a utility and transact their products and their services on the rail as a partnership, much like Mismo isn't a product. Mismo is data set. And the idea
Right.
of having something that is like a Mismo standard for blockchain built on a robust industry recognized set of protocols is, I think, the next step.
Yeah, that's again where that, sort of rating agency,
Yeah.
self-governing comes in really handy. It makes me think of Figures HELOC, which I
Yep.
think we all assumed at the time might go a little faster, like the blockchain aspect of that. I think we all were like, oh, this makes sense. But it shows you the length of time and dedication and investment you need to start making those changes. And so that protocol working group, like working on a, uniform agreed protocol like Hedera, means that now you can start to really push things, and it is going to take a long time. Mismo took a long time. Let's
It,
look. I mean,
it did.
that's
Yeah,
yeah,
and that's the benefit of Hedera. Hedera has a foundation behind it where it does fund industry initiatives like this. They recognize the market position that they play. They are a good actor, almost like the old Google model. Don't be evil. Remember that? Remember
yeah,
them
oh
that
yeah.
Google
Hmm.
model? That's
Yeah.
that's Hedera today. And what they're saying is, hey, we'll splash the cash to help people build the use case. We'll fund the working groups so that we can have the best and brightest available. And that's what we're working on. So there's a working group with some industry participants. At this point, it's very small. It's basically one voice in originations, one voice in processing, one voice into different component services, someone in servicing, someone in capital markets, all of us kind of mocking up what we think the protocols and data sets would be, what the workflow would look like, what the interchanges would look like, what the data structure would look like. And once we kind of get that down on paper, we're planning on inviting others in to kind of poke holes, to redline it, to say we like or don't like this, or it should be this way. But the idea of getting at least kind of an MVP on paper down and then inviting the criticisms and critiques. And the idea is that it's going to be Switzerland. It's no one's going to be allowed to own it. As much as um, there's a three-letter company pretty big that has most of the data, most technology in the market today. Their impetus is to own the ecosystem.
Right.
The idea is you can come in as a partner, but it's going to be Switzerland. It's going to be industry governed, much
Mhm.
like Mismo.
Okay. Yeah, I mean, I think that's a type of exciting thing to hear that we can keep an eye on. We have um, one foot in next and one foot in later
Yeah,
as
yeah,
we
yeah.
talk about some of these things, right? Because they're fluid. Alan's making the point in the chat that regulators have their view and don't get that more expansive view typically, especially at the state level
Yeah,
of some of the things
absolutely.
you're talking about. Let's shift for a second just to that federal level, because you made me think of it when you said, do no, Google's
Don't
don't
be evil. Yeah.
don't be evil.
Yeah.
It's actually funny. When I was a young regulatory compliance attorney, and one of the guest speakers who came to speak, it was either an ABA meeting or maybe one of the state banking in Massachusetts that brought in the British consumer finance regulator.
Yeah.
And in Britain, it's a very subjective system. They have a
Yes.
regulator who has one rule: do no harm to the consumer. And they decide what is harm, basically. So it's a
Much
very,
like Massachusetts, much like Massachusetts.
yeah.
And I'm from there too, so I know how it is. Yeah.
Yeah, and so one of the things you and I have been going back and forth a little bit offline about is what is changing at the federal regulatory level.
Yeah.
And when you think of innovation in this industry, you can't help but think of Fannie and Freddie, right? We have these secondary market things we can do, especially with industry standards and data. But when it comes down to delivering this stuff, we're still delivering so much of it through the GSEs or GSE-like guidelines. The GSEs make a guideline, then somebody else updates theirs, and then they make a change,
That's
and
right.
somebody
That's
updates
right.
theirs. And so,
Yeah.
so what are you seeing from the ability to prove some of this out 2025, 2026 that is changing, isn't changing, faster, slower? What's your take on what we're about to see?
It's such an interesting time. I um at least once a week have a regulatory call on the servicing side, and there's a lot of hand wringing at both the speed of change on the regulatory side and the lack of change on the regulatory side, or lack of clarity on the regulatory side. So I would tell you that with the way things are being driven in DC these days, it's mostly being driven by there's a goal of objective ideology of of certain outcomes, and not always irrespective of how the sausage is made. It's more of, I want this kind of sausage right now, and I don't care how I get there. And so you have decisions like the Vantage score changes,
Hmm.
which come from a really good place of wanting to drive down the cost of credit originations, but ultimately the effects of loan level pricing adjustments and other things aren't being properly weighed, such that you may end up with a more expensive outcome. Like things of that nature right now are what we're seeing out of kind of the ideology driven, result driven, versus it being driven by technocrats, people that have a deep subject matter expertise. So I would say right now, there's not going to be a lot of sensible innovation out of Fannie and Freddie at this point, but that may change very, very, very quickly, particularly as the end of the year rolls around and we begin to see some hiring and some back to common sense and moving away from kind of policy driven initiatives in fair housing to much more market driven to drive down pricing and innovate in a product set. So I do see hopeful things on the horizon. And that would also coincide with our conversation around privatization and whether that happens or not and what vehicle that takes. You know, I there's a lot to just, I could spend
I
30
know.
minutes just on that topic, but what we're seeing, what I think we're going to see though, Jeremy, is more more innovation on the private market side, the non-QM side of the house with different products and solutions. And they're going to be much more innovative. There's going to be private takeouts and capital. You have ICE really saying, hey, we're going to own an end-to-end manufacturing process. Oh, also, we own the New York Stock Exchange.
Yeah.
We have a place now where we could structure a marketplace for those assets, and you'd have confidence in the quality of them because of the data efficacy from point of sale all the way through the manufacturing into servicing. And so
Yeah.
there's a really interesting play there where I do think that for the first time in a long time, there's going to be a consortium of private actors that give the GSEs a run from their money from an execution standpoint and outcome standpoint. But as you said, the world still turns on the Fannie Freddie servicings and seller servicers, and all those uh, protocol changes that you see pushed down. The market reacts to it because it is generally driven. It is generally the gold standard, quite frankly. You know, and there's so much money in the market that is backed by the GSEs that they do when they throw their weight, the world moves.
Yeah. I think that's well said because that brings together a piece of everything you've mentioned this episode, which is it, and I have a little bit more of a Wild West view of it, so I'll describe
Yeah,
what that is in a second.
yeah,
But but your point is, look, we now have more rapid data analysis. Well, I should even go back one step further. We have better, more reliable data collection. That
yeah,
better data collection now results in better data execution and analysis for the secondary market. So ICE and others, private banks, private lenders, non-agency, are looking at this and saying, well, I can measure guidelines, mine or anyone's, Fannie Freddie's or mine. I can measure them better, faster, stronger in real time, and then put those loans out to market to a new
absolutely.
group of investors right next to Fannie Freddie. They may even be Fannie Freddie eligible, but I'm going to put them right next to them because of the rate at which I can collect the data, analyze the data, and move that loan through the process on my own. We haven't really seen that. We've talked about different iterations of it since before Dave
Forever.
Stevens was running the NBA, and like,
That's
yeah,
right. That's right. Yeah,
and now we're at a place where it might be happening. I actually think that is, if not entirely disconnected, very much disconnected from shares of the GSEs being sold. I really do. I think that work is going to move forward, and the capital markets folks
yeah,
and the banks and ICE can work on that. And
absolutely.
also, big banks and hedge funds might buy shares of Fannie and Freddie as well. They may or may not, and they're going to build this other thing you're talking about right next to an IPO-esque. I think it'll be small. I think it'll be 10% of each or 10 to 15% total of both of them in the next 6 to 10 months. But I think it'll be relatively disconnected. And similar to how we saw the administration buy some shares of Intel, I think that's how it's going to go. It's just going to happen and this other stuff's going to happen
I'm a,
too.
I'm a
And
little, yeah, I'm a
they're
little
not
more
coordinated.
skeptical on the IPO because of the capital market structures and the need to mollify international investors who are heavily weighted into U.S. residential real estate. I think that the market side, the capital inflows, I know we're just about the top of time, but the U.S. residential market has been viewed as the gold standard of investment by everybody in the world. And the reason why we enjoy such cheap capital relative to other assets is because of that. And then in the Fannie Freddie infrastructure really is the key to that. And
Mhm.
anything that screws with that is going to be looked at with incredible skepticism by the moneyed interests. And as much as I think that there's been test balloons on an IPO or other faster vehicles to end the conservatorship, it's got to be measured carefully to preserve those interests.
Thank you, man. This has been great. So quick recap, we see HELOC, HELOAN, and HEI all growing. We see maturity in the HELOC space that's coming, and it's going to require other innovations around it, including appraisal and title. You mentioned how these assets like second liens and title are now working together in
Absolutely.
more of like a data sharing, blockchain, real-time transparency system. All of those things are going to push innovation and the market into non-agency product and GSE reform, because we will see Fannie and Freddie have to do something to respond to innovation. They're going to have to respond some way. And their response might be, we're not touching it, but it also might be, we're hiring, we're growing. So you said, keep an eye on that. So between, where the home equities are going, where these technologies that support these new products are going, and then of course, keep your eye on DC, because it could alter all of this at any time. But your point's well made, which is there's a lot to do and there's a lot going on there. And so I think we're gonna have to have you back this fall so
Let
we
me
can
know.
talk
I'm always here
more.
for you.
We can talk more about this, because this has been a great half an hour, went way faster than I thought. But thank you, TJ. We appreciate it.
Make sure I appreciate it. Take care, everybody.
Take care, everybody. Thanks, and see you again. We're gonna skip Labor Day. We'll see you again on the Monday after Labor Day, September 8th. We hope to have Terry Davis from Cotality on, and
Oh.
look forward to talking to everyone then. Take care. Bye, TJ.